In this video, we're going to talk about stock prices in the stock market. And the biggest difference between, from an investor's point of view, between buying stocks and buying bonds is that bonds always have a maturity, right? They always will pay off in the end unless, of course, they default. Stocks don't have a maturity, right? Stocks theoretically could last forever. In actual fact, of course, they last until, the company goes out of business. But even when they go out of business, like sometimes they'll completely liquidate, sometimes they'll be bought by somebody else, and so you'll get maybe some stock from the company that's buying. So that can complicate things somewhat. Although in some ways I suppose it can simplify things as well. But the fact is that we have to compare the stock market and the bond market, because if you're an investor with $10,000 to invest, you have to think about, okay, well, do I want to buy stocks or do I want to buy bonds, which is going to offer me the highest return, while also thinking about the various risks. So first we'll think about it from the company's perspective. And so from the company's perspective, firms, they can finance themselves from a number of different ways. And we're actually going to talk about this a little bit more in the next chapter, in chapter 15, where we talk about sort of the role of profits in determining investment, right? So they can use internal finance. That's their own profits, right? So if you have profits and you decide to keep them and invest them in the firm, that's internal finance. External finance is bank loans, right? So that's always an option. And of course, smaller businesses will often tend to rely more on bank loans than larger businesses, but even larger businesses will sometimes use bank loans. Debt finance will be bonds and loans, right? So in terms of, a bond versus a loan, they're both debt. They're both things that you owe to somebody else. And then equity finance is issuing stocks or shares that pay dividends. Maybe pay dividends, right? So a lot of the tech firms don't pay dividends. Some of them will probably never pay dividends. So we'll talk about that in a minute. But most stocks do pay dividends. And so what is a dividend? Well, a dividend is a part of the profit. And so it gets paid out per share. And so if you're a firm and say you have, $1 billion worth of profits, you have to decide, okay, well, how much do I want to keep inside the firm and use for investment, and how much do I want to pay out as dividends? And so the dividend payment is going to be very important for which stocks investors buy, because the dividends will go to the stock owners, right? Okay, so let's compare stocks and bonds. So we said, all right, well, if you buy $1 worth of bonds in year T, then in year T plus 1, you have that dollar times 1 plus the interest rate, right? Stocks are more complicated. So we're going to say $Q is the price of the stock. $DE is the expected dividend, and the ex-dividend price is the stock price after the dividend has been paid. So actually, dividends are usually paid on a quarterly basis rather than an annual basis. And it's a little complicated, like depending on when you buy the stock, whether or not you will be eligible for certain dividends, right? You'll certainly be eligible eventually for the dividends, but you might, like if you buy right before the dividend date, you probably won't be eligible. So if you buy $1 worth of stock, you need to think, okay, well, next year I'm still going to own the stock. I will have gotten the dividend. So how much do I have? Well, I have whatever the stock is worth next year. That's the $QE T plus 1. Plus I have the dividend, whatever that is. So that's $DE T plus 1. And I paid $QT. So that's how much of a dollar I have. Now, in some stocks, especially if that dividend is 0, then it's all about do I think the stock is going to go up or do I think it's going to go down? Right? And if I think it's going to go up, I'm going to buy. If I think it's going to go down, I'm not going to buy. Or I'm going to buy, sell short. Okay. So for an investor who doesn't really care, right? They just want to maximize their value. Then equilibrium, the arbitrage opportunity, requires that the expected rate of return from holding stocks, which we're putting here on the left-hand side, has to be the same as the rate of return on one-year bonds plus the equity premium, right? And so this is going to be really important. This is the premium that stock owners sort of require because stocks are more risky than bonds, right? We already said that the interest rates that bonds pay are sort of adjusted for whether or not they default. So that risk premium is already sort of embedded in I. But then there's the sort of additional risk associated with owning stocks because the price of the stock can go down a lot. It can go up a lot. It's just a lot more volatile than a bond price. And so that is going to be our equity premium. And there's been many, many papers written about what's called the equity premium puzzle, because this equity premium seems to be too high to explain stock returns, basically. Okay, so now we've got the returns to a stock for a year equal to the returns for a bond for a year. And so now we can sort of solve this for this QT, right? That's the price of the stock today. And so the price of the stock today is equal to the dividend discounted by the discount factor, including the risk premium, plus whatever we think the price of the stock is going to be next year, also discounted by the discount factor, including the risk premium. So the thing about stocks, right, as we said, is that they go on forever. And so if we think about this in terms of n years, then the present value of the expected price has to just be, you know, the expected dividends discounted by the discount factor, right? And so this is the dividend next year, discounted, dividend in 2 years, discounted, dividend in n years, discounted, plus whatever we think the price is going to be in n years, discounted. So as long as the interest rate is positive, which we assume it is, then we can sort of simplify this a little bit, but it's still really complicated, right? And a lot of it depends on what the dividends are, but eventually the dividends are going to be all important for anybody who is going to hold the stock for a long time, right? Now that, of course, is not most investors, or at least most investors, they might expect to hold the stock for 10 years, which we would think is a long time, but they're not going to hold it for 100 years because in 100 years they're going to be dead. So we have to think about, all right, well, how many investors are thinking about sort of this long-term value, and how many are just sort of thinking about this short-term value, right? Maybe they're going to hold it 6 months. Maybe they're going to hold it a year. But that's going to be a different calculation. So if we replace the nominal interest rate with real interest rates, right, then the real stock price, right, so now we took away the dollar sign, so now we're talking about the real stock price, is going to be the real dividends discounted by the real interest rate plus the premium, right? So higher expected future real dividends should lead to a higher real stock price, and we do see that to some extent, right? So there are some stocks that pay a higher dividend and they tend to have higher prices. Higher current and expected future one-year real interest rates lead to lower real stock prices, or vice versa, right? Because right now we have really low interest rates, and we'll talk about this in a minute. Really low interest rates imply that stock prices will be high, and certainly that is what we have seen. Interest rates have been low for a long time, really since the beginning of the financial crisis in 2008. And that has really pushed up stock market returns since then. And then, of course, a higher equity premium leads to a lower stock price, and vice versa. And so we have seen a fairly high equity premium, which means that, if you are investing in something for a long time, if you're doing your retirement savings, for example, and you're 25 or 30 years old, then you want to invest in equities, right? Although generally you want to invest in something like a index fund with very low costs in order to reduce the idiosyncratic risk of any one company in order to enjoy the higher returns from the stock market. So this is just the Standard & Poor's 500 from 1970. So 1970 is just set equal to 1, so it's just an index here. And you can see this is in real terms, so this is controlling for inflation. You can see it was fairly low throughout the 70s and 80s. By 1995, it was up maybe, I don't know, 20%. And then we had the sort of dot-com bubble, right? And so, you know, the NASDAQ went up even more than this. Then we had the dot-com crash. Then we built up again. We had low interest rates throughout the 2000s, crashed again in the financial crisis, and now it's back up again. And it's back up back to where it was in the dot-com bubble, so even higher. You know, obviously, if you can predict the returns of the stock market, you can make a lot of money. And so a lot of people spend a lot of time trying to do just that. For the most part, stock prices are unpredictable, which means that, you know, if you don't feel like you have more information than the next person, you shouldn't be investing in individual equities. All right, so let's think about these low interest rates. You know, if the Fed drops the interest rate, right, so that, you know, we go from A to A prime, really should increase the stock market, right? Because now you can't earn as much in bonds, and so you are going to be more likely to invest in stocks, and that seems to be what happens. Although often, you know, what's important is like how long the market expects this to go on. You know, if it's a temporary drop, then it might not have much of an effect. But if it's a, you know, a drop like it was in the financial crisis, eventually, you know, bonds look very unattractive, and so compared to stocks, and so people will put more money into stocks, stock market will go up. Similarly, with an increase in consumer spending, a lot of it depends on what the Fed is expected to do, right? So if investors think that the Fed won't respond and keep the policy rate unchanged, then we're going to move from A to A prime as consumer spending increases, and stock prices will go up. If instead they expect the Fed to increase interest rates, then it could go down. And so this is why, you know, headlines about the stock market are always hilarious, because they don't really know what is going on. And so you can have like the same macroeconomic event leading to either an increase in the stock market or a decrease in the stock market. And, you know, really what's going on is it's all about what the market expects the Fed to do, which is why the Fed is very careful in its sort of market communications as well.